In this lecture, we're going to cover current liabilities. So we have accounts payable, accruals, bank loans, and commercial paper. These are some of the common current liabilities that you find in most businesses. We are going to discuss accounts payable in detail. The other current liabilities, we are just going to discuss the definitions over here. So what are accruals? Your accruals are continually recurring short-term liabilities. An example are accrued wages and accrued taxes. Basically, there are funds that are generated spontaneously because of the operations of the business. Accruals is something that I'm sure you must have studied in detail in your accounting. If you do not remember it, I would advise you to just go back and see the definition. Then we have bank loans. Now, over here I've written promissory note, line of credit, revolving line of credit. Basically, your promissory note mentions it is a document that specifies the term and conditions of the loan. So it is going to include all of the information about the loan. What is the amount that is being borrowed, for example? What is the maturity time? Is it a long-term loan? Is it a short-term loan? 30 days, 90 days, 1 year? So what is the duration of the loan? It will also mention the interest rate, whether it is fixed or whether it is floating. Then it will also mention the frequency of interest payment, how frequently interest must be paid. So is it monthly, quarterly? Similarly, it will also mention is there a collateral or not for the loan, and there might be some restrictive covenants, a loan guarantee. So basically, it is a document that contains all of the information regarding the loan. Then you have a line of credit. A line of credit is an agreement between a bank and a borrower indicating the maximum amount of credit the bank will extend to the borrower. So for example, if you have a line of credit with somebody which is for 80,000, and during the time period you take out a small loan of 15,000 for 90 days from this line of credit, you still have 65,000 that you can use for loan purposes. Now, this line of credit is usually informal and it is non-binding. Now, this is the difference between line of credit and revolving line of credit. Basically, revolving line of credit is like line of credit, but this one is formal and it is binding. So a revolving line of credit is a formal committed line of credit extended by a bank or another lending institution. So the bank has a legal obligation to honor a revolving credit agreement and it receives a commitment fee for it. And in line of credit, there is no legal obligation nor there is a fee. Basically, it is informal. Then you have commercial paper. Commercial paper is an unsecured, short-term promissory notes of large firms, and usually they have a denomination of $100,000 or more, with an interest rate somewhat below the prime rate. Now, commercial paper, we will also discuss this in detail in our later topics, so I'm not going to go into much detail over here. Now, moving ahead. Payables management. So payables are your suppliers to whom your payment is still due. It also arises spontaneously from ordinary business transactions. And there are two components to it, free trade credit and costly trade credit. Basically, people assume that payables is a free form of trade credit, but that is not true. We will see through an example that even your payables might have a cost attached with it. So free trade credit means that the credit that is received during the discounted period. So basically that is free. But if you're taking credit in the if you're taking credit taken in excess of the free trade credit, then there is a cost attached to it. This is the annual cost of trade credit formula. So it's discount percentage, 100 minus discount percentage multiplied by 365 divided by days credit outstanding minus the discount rate. Then the days payable outstanding formula is accounts payable, purchases, and divided by 365. So the days payable outstanding tells you after how many days are you paying your suppliers. Now let's look at some examples to understand both of them. First, we will go through the example of nominal annual cost of trade credit. So PPC Inc. buys 20 microchips each day with a list price of 100 per chip on terms 2/10 net 30. Now what does this 2/10 mean? It means that if you pay your suppliers within 10 days, you will get a 2% discount. But if you do not do so, then you will have to pay the full amount, but you can still pay the credit in 30 days time. So that means that the 100 rupees is not the price that you will have to pay if you pay within the first 10 days. In that case, you will have to pay a price of 98. And if you do not pay within the first 10 days, then you will have to pay this to finance charge. So with discounts, if you're paying within the discount period, that would mean that you have 20 microchips and you're purchasing them each day. So there are 365 days and you're purchasing them at a price of 98 because you're taking the discount. You'll make the payment within 10 days. So if you make the payment within 10 days, you will get 715,400 per year. So this will be your cost per year. Then without discount, that would mean that you will have to purchase it at 100, but you will be taking on more uh, you will be taking on the extra credit. So you will be paying within 30 days, but not during the first 10 days. But in that case, you will have to pay the complete 100 and multiply it by 365. This gives you 730,000 per year. So if you take the discount, if you pay within 10 days, this will be your cost. But if you do not take the discount and you pay after the 10 days, then you will have to bear this expense. You can see that it is higher. So from this formula, what you can do is you can calculate the percentage of cost that you will have to bear because you have lost on the discount. Basically, this is a formula to calculate what is the opportunity cost if you do not take the discount, if you do not pay within 10 days. So the formula is discount percentage, 100 minus discount percentage, then you have multiplied by 365. Days credit is outstanding minus discount period. So the discount percentage was 2%. So we've plugged in 2%. And this is also 100%. Okay. And we have multiplied it by days credit is outstanding. So the days that is allowed to be outstanding is 30. And this 10 over here represents the discount period. So if you do the calculation, your answer is coming 37.24%. This percentage is the nominal annual cost of the additional trade credit. So if the business can borrow for less than this 37.24%, it should take the discount, and vice versa for the other case. Now moving ahead to example number 2, the Flexo Paneling Company has beginning accounts payable of 145,000 and ending accounts payable of 157,000. On an annualized basis, its total expenses are this much. Determine its accounts payable days. We plug this information into the following formula. So we need to calculate the days payable outstanding. Accounts payable, again, you will take average. So you will take this beginning account balance of 145,000 and the ending account balance of 157,000 and plus them and then divide it by 2. Similarly, that you did it for the receivables as well. Then on an annualized basis, its total expenses are 1750. So we'll take these as the purchases amount because no other information has been provided to us. And if we do the calculation, it is coming 31.49 days. So you are paying your suppliers in approximately 31.49 days.